Friday, the 14th of September, 2007. A high street in England. People are standing in a line that goes past the shop next door and the shop after that. They are not waiting for concert tickets. They are waiting to take their own money out of their own bank. Here is the part that makes no sense. The bank is not bankrupt. It is solvent. Its mortgages are being repaid. The government has just promised it emergency support. Every official voice in Britain is saying the same sentence. Your money is safe. And the line keeps getting longer. Britain had not seen a queue like this since 1866, 141 years. Long enough that nobody alive had ever watched one form. So the easy explanation is panic. It usually is. Except the people in that line had done a piece of arithmetic that almost nobody else in the country had bothered to do. And the arithmetic said, go and stand in the line. Could it happen in your country? Northern Rock was not a strange bank. For most of its life, it was the opposite of strange. It began as a building society in the northeast of England. That idea, an institution owned by its own savers, lending their money back out to their neighbors, is one of the least glamorous inventions in financial history, and one of the most successful. In 1997, Northern Rock converted into a bank. By 2007, it was one of Britain's largest mortgage lenders. But somewhere in those 10 years, it stopped running on savings. Look at where its money actually came from in the summer of 2007. Ordinary savers, the people who would later stand in that line, accounted for about 27% of the bank's funding. Roughly 68% came from the wholesale markets, other banks, funds, and institutions lending short-term in bulk by screen. For comparison, a typical British bank at that time funded somewhere between 60 and 80% of itself from ordinary deposits. So Northern Rock had turned a bank inside out. It borrowed from the markets for months at a time and lent to households for 25 years. That gap is not a scandal. That gap is banking. The only question anyone ever has to ask about it is, what happens if the short end stops? Nobody asked, because it worked. The rates in the window were good, 6.71% on a one-year bond, and the money kept coming in. The 9th of August, 2007. On that day, a French bank announced that it could no longer put a price on 3 of its funds, and across the world, the short-term lending market did something it had not done in living memory. It simply stopped. Not crashed, stopped. The money Northern Rock rolled over every few months, the 68%, was suddenly not there to roll. The bank was still solvent, the mortgages were still being paid, but solvency and being able to reach cash this week are two different things. And a bank that cannot reach cash this week is a bank that cannot open on Monday. So Northern Rock went to the Bank of England and asked for emergency support. That request was meant to be quiet. On the 13th of September, it leaked to a television reporter. By the next morning, it was on every screen in the country, and the Bank of England confirmed it. And here is where the story gets misremembered. Everybody remembers the queue. Almost nobody remembers who ran first. The wholesale lenders ran first, the 68%. They ran in August, quietly, by simply not renewing. There was no queue, no camera, no photograph, and not one of them was ever described in a newspaper as panicking. The people who ran second were the 27%. They ran in daylight, on foot. And they are the only ones anybody photographed. £1 billion left the bank on the first day. About 5% of everything savers held there, gone in a single day. By the Monday, it was $2 billion. And if you were one of those savers, think about what your options actually were. The website went down. The phone lines were engaged. The post took days. There was exactly one channel left that still worked, and it was the pavement outside the branch. That is worth sitting with, because it repeats in every country and every decade. A bank run is not primarily a psychological event. It is a queuing problem. When 4 channels fail, everybody is pushed into the 5th, and the 5th one is the only one with a camera pointed at it. The newspapers called it panic. The chancellor called for calm. The savers standing in the line were interviewed and asked, more or less politely, whether they felt foolish. They did not feel foolish. They had read something the newspapers had not. Could it happen in your country? Britain had deposit protection in September 2007. It had had it for years. If your bank failed, you were covered. Here is how covered. The first £2,000 of your savings were protected in full. The next $33,000 were protected at 90%. 90, not 100. The last tenth of that slice was yours to lose. And that was deliberate. It was called co-insurance, and the point of it was to give savers a reason to care which bank they walked into. Add it up. 2,000 plus 90% of 33,000 is £31,700. That was the ceiling, not the average payout, the absolute maximum the scheme could ever pay any one person. Now put a real person in front of that number, someone who had sold a flat, or retired, or been paid out of a pension, and had £40,000 sitting in a Northern Rock account because the rate in the window was good. Covered, $31,700. Not covered, $8,300. Roughly a fifth of everything they had. And even the covered part was not money you could spend. It was a claim to be assessed over months. So look again at that line of people on the pavement and ask what a reasonable person does when they are told their money is safe, and they know that safe has a number, and the number is smaller than what they have. They go and stand in the line, not because they cannot think, because they can add. Could it happen in your country? The 17th of September. The Chancellor of the Exchequer, Alistair Darling, stood up and guaranteed all existing deposits at Northern Rock. Not 31,700 of them, all of them. The queues began to disappear the next day. Not because the bank had got better. Nothing about the bank changed in those 24 hours. What changed was the number. The government reached into the middle of a queue and rewrote the guarantee. And the moment the arithmetic changed, the behavior changed. A month later, this notice was taped inside the branch windows. Read the second sentence. This protects all retail savings in all accounts, regardless of the amount deposited. Regardless of the amount deposited. That is a sentence you only bother to print if, until very recently, the amount deposited was precisely what it depended on. And even then, even with an unlimited state guarantee in writing, a further £4.4 billion left the bank between the 18th and the end of September. Trust, once it has been counted, does not come back on announcement. To keep it standing, the Bank of England had lent it £26.8 billion. Every pound of that was eventually repaid, which is the detail people forget when they say the word bailout. On the 22nd of February, 2008, Northern Rock was nationalized. The savers got everything, every penny. The shareholders did not. Britain did not forget this. Within weeks, the 90% rule was gone. Cover became 100% up to a limit, and the limit began to climb. 35,000, then 50,000, then £85,000. The target for actually putting money back in people's hands was cut from months to days. In January 2008, a committee of the House of Commons published its report on what had happened. They called it the Run on the Rock. Read it now, and the striking thing is how little of it is about greed and how much of it is about plumbing. Who could reach whose money? How fast? And what number had been written down before anybody needed it? Every reform on that list exists because of a queue on a pavement. For 300 years, British banknotes have carried the same sentence: I promise to pay the bearer on demand. It is easy to read that as decoration. It is not decoration. It is the whole arrangement printed on the thing itself. Your money in a bank is not a stack of notes with your name on it. It is a promise. And behind that promise stands a second promise from the state. That second promise is not a feeling. It is three specific things: a number, how much is covered; a deadline, how fast you are paid; and a list, which accounts count and which do not. The United States has those three things. So do the United Kingdom, Canada, Australia, and New Zealand. Every one of them with a limit. The people outside that branch in September 2007 were not irrational. They were simply the first ones in a generation who had bothered to look their number up and had found that it was smaller than what they had. So before this is ever a story about a bank, it is a story about a number you have probably never checked. 10 months later, and an ocean away, a bank in California opened its doors to the same kind of line. Its name was IndyMac. About 10,000 of its savers were over the insured limit, around $1 billion sitting above the line where the guarantee stopped. Nobody rewrote the rule for them. They were sent half of it up front and told to wait for the rest. Same arrangement, different country. That is the next file. Could it happen in your country?